What's up everybody and welcome back to another video, and in this one we're going to be talking about two ETFs and one ETN which have dividend yields upwards of 20%, whether you should be buying these or not, I believe that they're a good position in your portfolio. So before I do go any further with this video, I'll ask if you enjoy the video, you make sure to give it a thumbs up and you subscribe. You turn on those post notifications so you don't miss out on any future videos. I'm posting every other day. I might change it to Monday, Wednesday, Friday, but we'll figure that out. Either way, you're going to be getting videos every single other day, trying to provide as much value as I can. I just got done creating this portfolio. It took me about a week or two to create this portfolio, kind of go through some different things. But I'll link it in the description below and even the comments so you guys can get this portfolio for 100% free. You'll see these slices. There's 6 different slices. They all have different holdings in them. There's 22 holdings in this entire portfolio. Expense ratio is 0.06% just because there are a few ETFs, and a dividend yield of 3.075%. It's a little bit more growth oriented, but there's still a nice dividend yield of 3.075%. So I'm not going to waste any more of your time. Let's get into the video. The first ETF I want to talk to you guys about is Columbia Research Enhanced Value ETF. Year to date, we are up 26.78%. Over the past year, we're up 8.29%. We did have a huge, massive dip in the December of 2020, but the dividend yield was still being paid out. We'll talk about this in a little bit, but we'll see 5 years we are up in the green, up 6.27%. That is one thing I can't stress enough. If you're going to yield chase, at least have something that's making like a 1% gains in the green. You don't want to just be chasing anything in the red. That is a very, very bad way to invest. Looking on this ETF, Revs tracks an index of U.S. stocks pulled from the Russell 1000 Value Index, and they use a multi-factor selection and market cap weighting to find what they like. So what they do is they track the index of Russell 1000 value, then remove stocks that don't pass the quality, value, and momentum that is put on their sector. And just looking on some of their different stuff, their biggest holdings right now conclude of Johnson & Johnson, Citigroup, Morgan Stanley, Goldman Sachs, Procter & Gamble. The list goes on and on. You got Google, Cisco. So I could list these, but let's talk about this dividend yield, which is what you're here for. Currently, they have a dividend rate of $4.67 per share, which yields out to 22.15% over the trailing 12 months. So there's a few cons to when it comes to investing in things like these. They're not that common, so the liquidity is going to be a little bit hard, as in the volume is only 1,718. So you should be able to sell shares if you were to buy some shares in this ETF, but it's just not going to be as much as like you would be able to with something like Apple, who trades on the hundreds of millions per day. And then you got an expense ratio of 0.19% because it is an ETF. Looking on this, we'll see they pay these dividends on an annual basis. But last year they paid in December, and it's October, it's the end of October, so we could be expecting this to happen pretty soon. So what's happening now? What we'll see is these dividends are kind of suspicious because they pay on an annual basis and they haven't declared when they're going to pay their next one. So it's something to keep in mind. These are very all over the place. You can see in 2020, the payment was just 15 cents. And then for here, it was $4.67. So these payments paid on annual, they're a little suspicious. It's very risky in my personal opinion. I do not personally have any positions in Revs right now. I think it's a semi-good portfolio addition, but very small amounts if it can pay the yield. If it can't pay the yield, I don't think it's worth a spot in your portfolio, in my personal opinion. But let's talk about the next ETF, which is actually not an ETF. It is an ETN, which is an exchange-traded note. And we'll talk about what an exchange-traded note is first off. So what they do is they're unsecured debt securities that track an underlying index of securities and trade on a major exchange just like a stock. So instead of being an exchange-traded fund like an ETF, it's an exchange-traded note. So they're just pretty much literally think of them like a bond almost. And what they do is they follow an index, and this one right here, USOI, follows USO index, pretty much United States Oil Fund. And so what these people do is they guarantee, right here, it's held by Credit Suisse. So what they do is they track this index. If USO goes up, let's say it goes up 10% on a year, you give Credit Suisse $100, okay? They take your $100 and they actually go invest it in whatever they might want to. They could go invest it in call options for Tesla, okay? They can do whatever they want. USO returns 10% on the year. So Credit Suisse owes you $100 that you paid plus 10% back. Okay, let's just say that they were to expire in 1 year rather than the 14-year expiration that it's from right now. Okay, that should be $110, but Credit Suisse is going to keep an extra dollar for expenses because they're doing this. So you get $109. Credit Suisse over here invested in Tesla calls, and they turned your $100 into $200. So they actually profited they pretty much profited $100, but then they have to pay you a little bit. So they really profited like $91 strictly from this ETN. They just have to be sure that they can make better returns than the index that they're tracking in that ETN. Another risk of buying an ETN is if Credit Suisse or whatever institution is providing this ETN, if they can back out and they can be like, hey, I'm sorry, our credit's not doing good, we're bankrupt, you're just screwed. Your entire investment is lost. So that is another thing to be cautious about when investing in ETNs. ETFs, that doesn't happen. But what we'll see right here is they are $5.60 a share, up 29.63% over the past year. Year to date, up 21.48%. So year to date total return, 44.39%. That is just USO. That is the fund that they're tracking. Okay. The fund as itself is up 25.12% over the past year with a whopping dividend yield of 21.27%. That's a huge dividend yield. Okay, Seeking Alpha says 19.68%, which is still huge stuff, which is more closely to it. I did the math, it was 19.64% when you take the dividend rate of the trailing 12 months divided by the share price. Now, looking on the dividends, they are currently paid out monthly, which we like to see this, consistent monthly income coming into your portfolio. And whenever you do this math, guys, if they actually continue to pay these dividends, for example, let's say you invested $10,000 into this ETN, if USOI says, hey, we're going to pay these dividends, you're going to be making roughly just $2,000 a year strictly from the dividends. That doesn't include the share price appreciation or the share price depreciation. You want the price to go up. So USOI, we talked about that they follow the USO, and they do covered calls on a front month oil futures ETF, USO. So they do these strike prices 6% of the money. They make this money, the premiums, and then they provide you with the dividends. So they're a cash flowing ETN, and they currently have an expense ratio of 0.85%. But let's talk about the third and last ETF on this list, which is AMOM, Craft AI Enhanced US Large Momentum ETF. Up over the past year is up 0.65%, and over the past 5 years, up 50.51%. They actually were initiated in 2019, so they haven't even been a fund for 5 years yet, just about a little over 2 years from now. Looking on some more stuff, they have a dividend yield of 21.04% with a dividend rate of $7.79 per share. Expense ratio is 0.75%. That's kind of what ARK's ETFs are. So if you're investing in any ARK ETFs, that's the same expense ratio that you're experiencing over there. Volume pretty low at 14,755. So liquidity is not super easy. Same thing applies from AMOM as we did with Revs. Dividend frequency is annual, yield of 21.04%, and a payout of $7.79 per share. We'll see right here they pay them out in December as well. So it's a little bit suspicious to know whether or not they're going to be able to pay these dividends or what they're going to be able to do. So I think that all three of these investments, if they can continue to pay these dividend yields, of course, they're great opportunities, but it's a very speculative and slightly risky bet because it can pay off very well, but it can also pay off very bad, and especially the ETN. But I don't think Credit Suisse is going to default and back out of their pretty well-known bank and institution, so they have pretty good credit ratings, I believe. So keep that in mind. These are very, very risky, I would say, if you're just in it for the dividend because you could just be ended up yield chasing. However, they all have proven to increase in value over the past few years, but they are a little bit new. So high risk, high reward, I guess we can call it. So let's talk about what this ETF really is, what AMOM is. It's an actively managed portfolio of U.S. large cap equities chosen with the aid of artificial intelligence. So they use AI to find systems within 3 to 36 months and find stocks in the past and rank them by the residual returns, which are defined as the total return after removal of market size and value risks factored into portfolio construction under conventional portfolio management. So that's honestly very, very confusing. What I'm getting from this is they're taking the fact that these residual returns will make these stocks historically and futuristically perform better than just conventional momentum stocks. So they're kind of taking in order their market, their size, their moat, the value, that's all factored into the risk into reward ratio. And they're kind of getting a deeper dive into momentum stocks and believing that these ones who are beating the momentum of momentum stocks will beat regular momentum stocks, which is pretty simple. And then the fund limits its weighting of a single security to 10%, and no more than 40% of the funds can be invested in securities with more than 5% weighting in the portfolio. So some of their top holdings are consisting of, right now, we can see Amazon, Home Depot, Lowe's, Target, DocuSign, Align Technology, and a huge dividend yield. But guys, that is what I have for you in this video. If you enjoyed it, make sure to subscribe and turn on post notifications for videos so you don't miss out on any future valuable videos. I'm trying to give as much content as I can. Make sure to follow me on Instagram and TikTok, especially Instagram, posting twice a day, every single day on there with great graphics. Check it out. Link is in the description below. But guys, again, thank you. Check out M1 Finance if you want to start building your pie. And you can see the bunch of different things that they offer. It's free $30 if you use the link below. So thank you again for making it all the way to the end of the video. And I'll see you at the next one.